Most people are either dramatically over-insured or dangerously under-insured. The industry does not help. Here is the calculation. When you sit across the desk from a life insurance agent, you are at a distinct mathematical disadvantage. The agent is backed by actuaries, decades of psychological sales training, and commission structures designed to incentivize the sale of complex products. You, on the other hand, are likely armed with nothing but a vague sense of financial responsibility and a fear of leaving your family destitute. This information asymmetry leads to two distinct financial tragedies. First, we have the underinsured. This is the young family that buys a $250,000 policy because it sounds like a lot of money, only to realize, upon a tragedy, that it barely covers 3 years of living expenses. Second, we have the over-insured and dangerously under-invested. This is the high earner who gets suckered into a $15,000 a year whole life policy under the guise of infinite banking or tax-free wealth, sacrificing millions in lost opportunity costs. To take back control of your financial life, you must strip away the marketing jargon and look strictly at the numbers. We are going to dismantle the popular math the industry uses and replace it with actual income replacement calculations. If you want the best return on investment for your time today, hit the subscribe button. Let us start with the setup, the common belief that gets most people into trouble. If you search for how much life insurance you need, you will almost instantly be introduced to the DIME formula. DIME is an acronym created by the insurance industry to help consumers calculate their death benefit needs. It stands for debt, income, mortgage, and education. You take your total non-mortgage debt, you add your annual income multiplied by 10 or 15 years. You add the remaining balance on your mortgage, and finally, you add the estimated cost of sending your children to college. At first glance, this makes perfect logical sense. It covers all the major financial burdens a grieving family would face. It gives you a nice, clean number to hand to the insurance agent. But logic and accounting are two very different disciplines, and assuming they are the same is exactly how you end up buying twice as much coverage as your family actually needs to survive. Here is the trap. From a strict corporate finance and accounting perspective, the DIME formula fundamentally double counts your expenses. Let us look at a case study of a 35-year-old sole breadwinner earning $100,000 a year after taxes. They have a spouse, 2 toddlers, a $400,000 mortgage, $30,000 in debt, and a desire to fund $100,000 in future college costs. If we use the DIME formula with a 15-year income replacement, we get $30,000 for debt, $1.5 million for income, $400,000 for the mortgage, and $100,000 for education. That brings the total recommended insurance need to $2,030,000. The insurance agent happily writes a policy for over $2 million. But let us look at the math from a cash flow perspective. When you were alive and earning that $100,000 a year, what was that money doing? It was paying the mortgage. It was paying down the car loan. It was going into a college fund. If your life insurance policy replaces your $100,000 annual income, and your surviving spouse uses that income to pay the mortgage and the car loan, why did you add the total principal balance of the mortgage and debt to the death benefit? By adding your principal debts to your income replacement, DIME double counts your liabilities. This results in you buying far more insurance than you mathematically need. The psychology behind this is simple, and it is exactly why the industry loves the DIME formula. It plays on your fear of leaving massive debt behind to the people you love. It artificially inflates the death benefit, which in turn inflates the premium you pay, which ultimately inflates the agent's commission check. You are paying real money today to protect against a phantom mathematical liability tomorrow. You are literally buying coverage for the exact same dollars twice. If you think that double counting is bad, wait until you see the actual math you should be using. This brings us to the protocol. Instead of relying on a catchy acronym, we must look at life insurance through the lens of present value and capital depletion. The true purpose of life insurance is to replace the economic value of your human capital. The capital depletion model asks, what lump sum of money, invested conservatively today, will allow my family to withdraw my missing income every year, adjusting for inflation, so the money runs out exactly when my dependents no longer need it. For our breadwinner, we need $80,000 a year, reducing the original $100,000 because the deceased person's personal consumption is now gone. We need it for 20 years, assuming 3% inflation and a conservative 6% investment return. Using the present value of a growing annuity, we calculate a real rate of return of roughly 2.91%. Factoring that over 20 years, the present value is $1,200,000. By using actual mathematical modeling rather than industry rules of thumb, you just saved yourself from buying over $800,000 worth of unnecessary insurance. Once you realize exactly how much insurance you need, the industry presents its second hurdle. What kind of insurance should you buy? The personal finance community generally adheres to a strict mantra to buy term and invest the difference. However, the life insurance industry spends billions marketing permanent life insurance, like whole life, as an alternative investment class, a tax-free retirement vehicle, and a family bank. The setup for this pitch is incredibly persuasive, because human beings naturally hate the idea of wasting money. The agent will tell you that term life is just renting your insurance, and whole life is actually owning it. They will ask why you would pay premiums for 30 years just for the policy to expire with zero value. With whole life, they say you build equity. Term life charges a flat premium for a set period, and if you do not die, it expires worthless, operating exactly like your auto insurance. Whole life charges a much higher premium forever, putting a portion into a cash value account. Let us run the 30-year numbers and look at the trap. John is 30 years old and knows he needs exactly $1 million in life insurance. He gets two quotes. The 30-year term policy costs $600 a year. The whole life policy costs $9,600 a year. The difference is exactly $9,000 a year. If John chooses whole life, he pays out of pocket $288,000 over 30 years. Whole life policies are notoriously opaque, but historically, the cash value yields an internal rate of return of roughly 3 to 4% after the insurance company subtracts its fees and the internal cost of the death benefit. Because commissions are heavily front-loaded, his cash value will be zero for the first few years. Assuming a generous 4% return, at age 60, John will have approximately $450,000 in cash value. The agent takes a victory lap, pointing out John paid $288,000 and now has $450,000 plus the $1 million death benefit. It looks like a massive win on paper. Here is the twist, and the massive opportunity cost most people miss. Let us look at the buy term and invest the difference scenario. John buys the term policy for $600. He takes the remaining $9,000 a year and automatically invests it into a low-cost S&P 500 index fund. Assuming a conservative 8% annualized return over 30 years, his investment portfolio grows to $1,118,000. At age 60, his term policy expires. Does John care? Absolutely not. He's sitting on over $1 million in liquid cash. He is now completely self-insured. By choosing term over whole life, John increased his family's ultimate net worth by over $668,000. If you want to run these exact wealth-building numbers for your own life, you need a rigorous system. Mid-video is the perfect time to mention the official Tom Talks Money Ultimate Personal Finance Dashboard. It is the exact digital spreadsheet template I use to track my investments, project debt payoffs, and map my monthly budget. It calculates these compound interest variables automatically, so you never get trapped by bad math or an agent's shiny brochure. You can find the link to the templates right down in the description. Now we reach the protocol for dealing with the whole life agent's final defense, the myth of infinite banking. If you think the cash value returns are bad, wait until you hear how they let you access your own money. The pitch is that you can borrow against your cash value tax-free to buy cars or fund businesses, acting as your own bank. Here is why that is fundamentally misleading. It is not your money you are borrowing. You are taking a loan from the insurance company using your cash value as collateral. They typically charge you 5 to 8% interest on that loan. While your underlying cash value is earning a 4% dividend, you are suffering a negative arbitrage. Furthermore, any outstanding loan balance is subtracted from your death benefit if you die. Mathematical efficiency always favors owning your capital outright over leasing it back from an insurance carrier at a premium. Now that we have established that term life insurance, coupled with disciplined investing, is mathematically superior for almost everyone, we must look at the hidden nuances that impact your coverage over decades. Let us start with the setup of inflation erosion. When you buy a $1 million term policy at age 30, it is worth exactly $1 million. But what happens if you die at age 55, in year 25 of the policy? Due to the time value of money, a fixed lump sum loses purchasing power every year. If inflation averages 3% annually, the real purchasing power of your $1 million policy in year 25 drops to roughly $477,000. To an uneducated buyer, this looks terrifying. The agent will use this exact present value math to scare you into buying an expensive permanent policy with a rising death benefit. But here is the trap. The agent deliberately ignores the inverse correlation between your insurance needs and your wealth accumulation. In year 1, you have zero savings, a massive mortgage, and young dependents. You need $1 million in pure purchasing power, and your policy provides exactly that. By year 25, your policy's real value has dropped significantly. However, your mortgage is largely paid off, your kids are out of college, and your investment portfolio has grown substantially. Your real need for insurance has dropped faster than the inflation-adjusted value of the policy. You do not need a policy that keeps up with inflation because your financial liabilities do not scale with inflation. They expire. This brings us to the actuarial truth about mortality tables. Why is term insurance so cheap? Because the insurance company knows something you do not. You are probably not going to die. It sounds blunt, but it is the entire foundation of the life insurance business model. Let us look at the twist regarding exactly how safe the insurance company is playing it. Life insurance pricing is governed by the Commissioner's Standard Ordinary Mortality Tables. According to the current tables, the probability of a healthy 30-year-old male dying before age 60 is roughly 6.5%. This means there is a 93.5% chance that your 30-year term policy will expire worthless. Insurance companies are incredibly sophisticated casinos. Out of every 100 term policies they write for 30-year-olds, they only pay out on 6 or 7. They collect premiums from the other 93 as pure calculated profit. Life insurance guarantees a negative return over 93% of the time. You should view it exactly as you view a fire extinguisher in your kitchen. You pay a small price for it. You hope you never have to use it, and you certainly do not view it as a wealth-building tool. But before you write off permanent insurance entirely, there is a specific protocol where the math actually works. This is the 1% exception. If you have an estate value exceeding $13 million, or $27 million for a married couple, you face massive federal estate taxes. If an ultra-high net worth individual owns a $40 million commercial real estate empire, their heirs might owe the IRS $10 million in cash within 9 months of death. They likely do not have that sitting in a checking account, forcing a fire sale of the properties. The mathematical solution is an irrevocable life insurance trust funded by a massive whole life policy. The policy pays out $10 million in tax-free cash to the trust, which immediately pays the IRS, keeping the real estate empire entirely intact. In this rare scenario, whole life is not an investment, it is vital liquidity provisioning. But unless you have an 8-figure net worth, this math simply does not apply to you. If you think traditional whole life is a trap, wait until you see what the new generation of products does to your money. As consumers grew wiser to the dismal returns of traditional whole life, the industry evolved. Enter Indexed Universal Life, or IUL, the current darling of social media insurance agents. The setup is tantalizing. They promise you can participate in the upside of the stock market with zero downside risk. Your cash value is tied to a market index like the S&P 500. If the market goes up 20%, you make money. If the market crashes, your account has a floor of 0%. You never lose a single dime. It sounds mathematically impossible, primarily because it is. IULs do not actually invest your money directly in the stock market. The insurance company buys safe bonds and uses the small interest yield to buy call options on the index. It is an incredibly complex derivative strategy disguised as a simple savings account. Here is the mathematical trap of the IUL. Because those call options cost money, the insurance company places a cap rate on your returns. If your cap rate is 8% and the market goes up 25%, you only get 8. Over a 30-year historical period, the IUL drastically underperforms the actual index because you systematically miss out on the massive bull market years that drive true compound growth. But the real twist is the internal cost of insurance death spiral. In a universal life policy, the actual mortal cost of insuring your life goes up every single year as you age. At age 75, the actuarial risk of you dying is massive, so the internal cost deducted from your account skyrockets. If your cash value did not grow fast enough because of those cap rates, the internal cost will cannibalize your cash value from the inside out. Before we cover exactly how devastating this ending is, if you want to master these concepts and get priority replies to your personal finance questions, hit the join button below the video to become one of the optimizers. You will get custom sketch badges and direct access to our Inner Circle community discussions. Here is the final protocol on how the universal life trap closes. Once your cash value depletes to 0, the insurance company sends you a letter stating your policy is critically underfunded. To keep your death benefit active, they demand a new premium of $4,000 a month. Because you are 75 and living on a fixed income, you cannot afford it. The policy lapses. You lose the death benefit, you lose all the money you paid in over 40 years, and the insurance company walks away with total profit. The life insurance industry thrives on obfuscation, but the math is entirely solvable. Do not use the DIME formula. Buy term and invest the difference in low-cost index funds. Separate your pure insurance needs from your long-term investments. Trust the compound interest equation and embrace the goal of self-insurance. The ultimate objective is to accumulate enough capital that by the time your term policy expires, you simply do not need life insurance anymore. I want to hear your perspective on this. Drop your own math calculations or experiences with life insurance agents down in the comments for some peer review. Keep optimizing, and I will see you in the next one.